Flex your business with an American Express Business Gold Card. You'll earn 4 times membership rewards points on your top 2 eligible spending categories, like transit and electronics, each month, on up to $150K in combined purchases per year. Plus, you can now earn 3 times membership rewards points on flights and prepaid hotels booked on AmexTravel.com. Terms and points cap apply. Learn more at AmericanExpress.com/business-gold. Amex Business Gold, built for business by American Express.
Hey guys, welcome back to the show. Today we're going to talk about traders' intuition and trading off of feel, and why exactly as traders we want to do it, what is the actual brain reason why we do it, and of course what are things that we can do to stop doing it. If you guys are brand new to the podcast, my name is Akil Stokes. I am your host of this lovely and delicious show. Thank you as always for joining. Make sure you take the 10 episode challenge if you're brand new. That means pick 10 random episodes of the almost 1,100 that we have here. Give it a listen, and if you find it to be helpful in your trading journey, become a frequent follower, which is something that I try to say all the time and can never get the 2 F's to come out sounding like words, and now I'm butchering words just to make up for the mistake that I didn't make earlier. Welcome to the show! Speaking of the 10 episode challenge, if you're into topics like trading mistakes, if you find yourself in that category where you are someone that is making a lot of them and you want to stop, I recommend checking out Trading Coach Podcast episodes 973, where we talk about technical analysis mistakes, 1069, where we talk about kind of where and when most trading mistakes happen, 924, the most common trading mistakes, 891, avoiding the killer mistake, and 669, overcoming fear-based trading mistakes. Again, I'm sure there's a lot more than that out there, but those are a few that I jotted down. Let's talk about this trading mistake, because trading off of intuition, or trading off of quotes feel, is a massive trading mistake. The reason that we want to do it is because it feels cool, right? We do it because it is cool to be a trader that trades off of feel. It is something that we all dream about. First and foremost, as human beings, we all have egos. Some of us have larger egos than others. And unfortunately, in the trading space, many newer traders have extremely large egos where they are extremely overconfident in their ability and really underestimate what it takes to be successful in this field. That kind of goes hand in hand with the fact that as human beings, we're also very irrational. And again, trading specifically, we somehow think that despite the very, 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 very low success rate of traders that are actually consistently profitable, we can somehow make it and become one of the successful ones without any training, without any time, or without any effort. We kind of just naturally have that thing, right? It reminds me of some of the sports parents that I hang out with where, they believe that their 10-year-old son is going to be professional, because everyone knows that by 10 years old, you can tell if someone's going to be pro or not. And of course, everyone knows it's that easy to become professional. Another kind of analogy that you can make is think about it as hey, I'm going to be a brain surgeon, but I'm not going to go to school to study anything. I'm just going to hop in, put on some gloves, and do it. We tend to think more rational when it comes to stuff like that, but as far as trading goes, we think it's super easy. Who knows why? Another reason that traders trade off of ego and feel is because it's fun, right? I mentioned this before. It is the fun factor, right? It's very similar to gambling, right? Why do we go to gamble? Now, many of us will say that we go to gamble in the casinos because we want to make a lot of money and we've got this super secret trick or strategy figured out that we're going to outsmart the casinos because those businesses are going out of business because people are so good at gambling. The truth is, right, most gamblers leave the casino with much less money than they entered the casino with. And they really go because of the enjoyable time, the bells, the whistles, the drinks, the noises, the excitement of rolling the dice and losing money, but rolling it again off of the hopium that you may win next time. And trading is the same way. So many traders come into the market with this gambling mentality where it's just I'm here, I'm going to do it, and it's fun, right? They're losing money, which isn't so fun, especially when you start taking it seriously. But at the beginning, it's kind of fun because it's this excitement boost that you get that is kind of addictive and makes you want to do it again and again. It reminds me of kind of a former NFL quarterback, RG3 we called him, Robert Griffin III, who was this extraordinary athlete who would run all over the place. He'd make people miss left and right, and he was probably the most fun quarterback to watch at the time. However, the reality was that his quarterback career got cut very, very short. I don't know if he made it. I think he got injured like in his first 3 years because in all that scrambling and all that fun, he kept getting hit very, very hard by extremely giant human beings, and a small-framed person doesn't really last long when you're taking big hits from big human beings coming at you at very fast speeds. Trust me, as a former football player and someone who is dealing with a pinched nerve right now, I can tell you that those hits do take a toll on your body. So all that fun he had running around, it ultimately ended in him kind of ruining his career and not being able to live up to what he was supposed to do. And that is, the trading equivalent of going broke. And don't get me wrong, right? I'm not trying to poo-poo this. I'm not trying to say that, hey, I'm better than you. I started in the same place. Again, if you guys are new to the podcast, listen to episode 000 where I share my story. I was a struggling trader, and for many years before I got on the right track, I was this gambler in the market. I had very good success in the stock market. I came to the Forex market thinking it would be a place that I can make more money using less money in a quicker amount of time. And in a sense, I kind of did my business in the stock market off of feel. I was more fundamental-ish. And I went to technical analysis and thought it would be the same way. And it just wasn't the case. But I would enter trades. I'd get excited. I'd lose money. I'd enter more trades. I'd get more excited. I'd lose money. Because you know how it is. The market, every once in a while, between those 10 losing trades, right, there's always that one that goes your way. And for some reason, you think that one is the one that has really allowed you to turn that corner and make it big time. This was me in golf back when I thought I'd be a professional golfer, where I'd shoot like, we called them snowmans, right? 8s on every single hole. But on like the last hole, I would get like a par or a birdie, and I'd be like, you know what? I'm back. And I'd sign up for another round the next day because I thought I solved it, only to go shoot snowmen again for the rest of the rest of the 18 or 17. I always had that one good one. But that was a cycle that I was consistently in trading. And I didn't really break this cycle until I experienced enough pain where I had to break it. And for me, experiencing enough pain was losing a massive amount of money to the point where it was like, ooh, it's almost gone. Kind of similar to like a credit card bill, right? For you guys that, you have credit cards, you have all this credit, you're like, I can spend freely. And then when you get close to that balance, you're like, that max balance, you're like, I better start tightening things up. But typically by the time you do that, it's way too late. So don't get it wrong. Although it may not feel like it, trading by intuition, trading by feel is a mistake. And the whole solution, which we'll get into a little bit later, starts off with deciding, how do you want to handle mistakes? Are you someone that wants to learn from your mistakes, or are you someone that wants to just blame others? I think it was Henry Ford who had this great quote that said, whether you think you can or you think you can't, you're right. And essentially that means there's two ways of thinking, right? One way of thinking is like, hey, like when things get tough, I'm going to put in more effort. I'm going to find solutions and I'm going to get things done and change it. And then the other way of thinking is when things get tough, either I'm not good enough, things will never change and I'll quit, or you just blame something else. Oh, it's not my fault. And then you continue to repeat the same mistake. So it all starts off by understanding, hey, what side do you want to be on, right? And you have to make a conscious effort, right? Do you want to be on the side that admits that they're making mistakes and works really, really, really hard to find solutions to those mistakes? Or are you going to be the type that just blames others, or maybe you don't think you're smart enough, or you don't think you have it in you, whatever that would be that's in you, to fix them? And I can tell you what, in trading and in most things in life, there's a wrong and a right side to be on, because one side is always going to result in failure. The other side may not result in success, but it gives you a chance to make success, to be successful. And I'm a firm believer in that, most people fail because they give up before having a chance to succeed. Meaning that if you are consistent with trying and messing up and learning and trying and messing up and learning and trying and messing up, eventually you will run out of ways to mess up and you will find success. Similar to Thomas Edison with the light bulb. I forgot his quote as well, but I think it was like, I failed 100 times and only needed to get it right once, and boom, there you go. Although I heard he stole that idea from someone else, but we won't get into that. So we're gonna take a little bit of a deep dive into kind of the psychology, I guess, of why these mistakes happen. That way you have a better understanding, and hopefully with the better understanding, it allows you to kind of think more about finding these solutions. And understand that pain is a stronger motivator than pleasure, right? And within that pain, there are two different types of pains. We're gonna call one physical pain, we're gonna call one mental pain. So physical pain would be like something that physically hurts you, right? The best example is like touching the hot stove, right? As a kid, we've probably all done it. We've touched a hot stove, ouch, it hurts. And then we've hopefully never did it again in life, because but every time we get near that stove, we have this harsh reminder of this physical pain, and the body is like, hey, dummy, never do that again. Not smart, right? Fool me once, shame on me. Fool me twice, not gonna happen. Mental pain is a little bit more different, if that is the right way of saying things, a little bit more different words again, right? Because our brain doesn't store it the same way, right? So the brain is this supercomputer, right? And it organizes things and it stores things, right? So everything that we take in, including this podcast and everything else that you do throughout the remainder of the day, is information that is taken in by the brain. However, it is impossible for your brain to store all of this information in complete detail. So what it does is it makes like these little, let's call them like shortcut folders, where it doesn't get all the information, but it gets enough that you can kind of connect the dots later and kind of draw a conclusion for it. So it's like a space saver, I guess you can say. And when it creates these space savers, it's called heuristics, right? And think of heuristics as being like a quick shortcut, as I mentioned earlier, to solving complicated problems, where again, you have kind of big details on the outside, the middle is a little bit blurry, and you're connecting the dots and basically making assumptions. So, here's a good example. The other day, I was leaving the weight room the other day, getting in the weight room, getting swole so I can do more Trading Coach podcast episodes for you on video with tight shirts and make myself feel good as the bicep slowly peeks out from under the sleeve. And I was leaving and I saw like I don't want to say a shadowy figure because it was during a day, but I saw a figure that kind of got my spidey senses tingly. It was a person walking. They were in all black. They had their hood up. It looked a little suspicious. So I'm walking to the car. I'm all alone, right? There's no one here at the gym. I have my own little gym thing. Just me, no one else around. So I'm paying attention. I'm paranoid as it is from Philadelphia, PA. And I'm walking down and I see this person. I'm the only car in the parking lot. I see this person just standing right, like literally on the back of my car. And I've learned enough during my years that there's two ways to approach this. One is to confront, and the other is to avoid. And from my fair share of confrontations, especially at this part in my life, that's not kind of the approach I want to take. Let's just say that. So I decided to do a beeline. Instead of walking to my car, I kind of walked around and did some other things that I had to do, kind of keeping my eye on this figure, right? Because I knew, something was about to go down. So I waste probably like 5-10 minutes doing like this extra work, doing circles, cleaning up stuff to kind of give them time to see like, hey, is this person like going to follow me, or is this person going to go off on his way? And this is a perfect example. Nothing happened, by the way. I'm still here. I do think I made the right decision in that moment just based off of my spidey sense. He's probably just trying to sell me drugs or something like that. But you never know. It could have been a mugging. Could have been, who knows. It's happened to me before. I don't want to let it happen again. But the fact was, I had no proof that this person was here to harm me. But by putting two and two together, shady looking figure posted up by my car with no reason to be there, that this was probably a troubling situation. So I made the decision to avoid. That is heuristics. And believe it or not, but we do the same thing when we're looking at a chart in trading. The reason I made that decision and made that judgment call, that assumption, is because I dealt with situations before where I was robbed and mugged, and this was eerily similar. Not exactly the same, but eerily similar. And on a chart, we do the same thing. We are taking past information, past experiences that we've experienced or that we've seen, and we're drawing kind of real-time conclusions from that, which may seem like a good thing, but remember, these are blurry conclusions where we don't know all the details because we're trying to quickly solve this problem and make a prediction. Now, the biggest difference between trading is going to be the risk and reward. In my situation, the risk of avoiding this character was nothing, right? I wasted 10 minutes of my life doing something that I should have been doing anyway. That's pretty much all that was at risk by avoiding. The reward was missing out on avoiding a situation that could have ended pretty badly. In trading, however, it's a little bit different. The risk of avoiding something that we should be doing, or the risk of doing something that we shouldn't be doing, that can cost us money because, again, we don't know what the outcome is. We are making an assumption. We are guessing blindly based off past information. And if we make the wrong decision in trading, it can cost us money. Either cost us money by being in a bad trade that we're not supposed to be in, or cost us money by avoiding a good trade that we were supposed to be in. Then when you add the fact that, again, humans aren't really rational, that many of us, especially traders, are very egotistic, we tend to value what felt right versus what was actually right. And this is kind of the whole process over outcome thing where many traders can't get it through their heads when we talk about, hey, there are 4 types of trades. There are winning trades, there are losing trades, there are good trades, and there are bad trades. Winning trades are profitable trades, losing trades are non-profitable trades. Good trades are trades that follow your rules 100%. Bad trades are trades where you don't follow your rules 100%. And they can't understand that, hey, you can have a winning trade that is a bad trade because you didn't follow your rules, it just happened to make money, and that you can also have a losing trade that is a good trade because you did follow your rules, but it did lose money. They value more kind of the win, the loss, the profit, the loss, and what it felt like. And because of that, we will continue to do the same action over and over again. One of the most dangerous things for a new trader is starting off hot. I spoke to a trader on our tier 1 platform the other day who he's up 12% in his first 2 months of live trading, and he was getting a little bit scared. And what I usually do in this situation when evaluating, I don't really care about the ROI. I said, congrats, good job, 12%. That's a great start. You got a little cushion to absorb that drawdown. But more importantly, were they good trades? Like, yeah, they were good trades. I'm like, that's what matters because that's what's going to give you consistency over time. What gets a lot of traders into trouble is when they have a good start, but maybe they're not taking good trades, right? They have a 12% start, they're taking random stuff off of feel and intuition, and then they start expecting this to be normal. And it's like, well, why would you go back to follow rules if what you're doing is currently making you profit? And it's that thinking of the short term and not the long term that gets many traders in trouble. And then when things take a wrong turn, they panic and they ditch their system and strategy, and it goes down this really, really dark place. So the ego and the fact that we're irrational and unrealistic is what allows us to keep repeating these same mistakes instead of learning from them. You also have to take into the fact that when our brain acquires this information, right, the whole concept has been kind of partial information, kind of summaries instead of details, is that we don't take a look at the whole picture. We tend to only take a look at the picture that matters to us. So we only pay attention to certain parts. And what this means is that, this is going to be a little bit weird to say, but we tend to notice things that repeat, even though those things that repeat aren't necessarily patterns. Now you're saying to yourself, how can something that repeats not be a pattern? And that if we look up the definition of pattern, it is probably something that repeats. Well, it's a little bit different. And maybe I'll rephrase this where we tend to notice the things that we want to notice when they're important to us. And we kind of create patterns from things that aren't patterns. So a good example is this. Let's say that you go and you buy a new car. You get a all black Range Rover, right? And you're like, man, I've never seen an all black Range Rover. I got it. This is nice. And then all of a sudden, as soon as you go on the road for the first time, what do you notice, right? Oh, look, there's an all black Range Rover. Oh, there's an all black Range Rover. Oh, there's an all black Range Rover. And we're kind of like, man, everyone decided to get an all black Range Rover the same day that I decided to get an all black Range Rover, right? And the truth is, like, these cars were always there, right? You just never noticed them because they weren't important to you until you became part of that club with the all black Range Rover. That's your brain choosing to ignore patterns that were irrelevant to your world at one part. And then all of a sudden, when something became a part of your world, now it's paying attention to it. And this is relevant in trading because in trading, a trading strategy is the ability to recognize patterns, right? It doesn't matter what your trading strategy is. It could be a trading news-based strategy based off fundamentals. You're recognizing patterns. It could be an indicator-based strategy where you're looking at MACDs and moving averages and Keltner channels. Guess what you're doing? You're recognizing patterns. You can literally be a pattern trader, double tops, double bottoms, simple patterns, head and shoulders, classic patterns, Gartley's, bats, harmonic patterns. They are all patterns, even individual candlesticks and candlestick combinations like higher high, higher closes, or 3-bar reverses, or supply and demand zones, right? Those are all patterns. So technical analysis and trading in general, even on the fundamental side, is all about recognizing patterns. So if our brain is choosing what patterns to recognize and what patterns not to recognize, not based on if they're actually being repeated, but based off of kind of our importance to us at the time, that can get us into a lot of trouble. And again, what does that mean, Akil? In a trading example would be like, let's say you watch a YouTube video, right? Probably on my YouTube channel because it's the best out there, right? At Akil Stokes on YouTube. Check it out. And I do a video on double bottoms. Well, now all of a sudden, you go to your chart and guess what you're seeing all the time? Double bottoms, because before it wasn't important to you, now it is, and now you can't stop seeing it, and you believe it's a pattern. And yes, double bottom is a pattern, but it's not a profitable pattern in its own right. I can tell you from personal experience as someone that went into the market naively, if that's a word, and looked to trade double tops and double bottoms all by themselves, I would have been better off just throwing my money out the window and hoping that the wind blew some of it back in, right? That's how bad it was. So yes, it was a pattern, but it wasn't necessarily like a repeatable, profitable pattern. It was just something that I was excited about because I could recognize it and I saw it. And in my mind, I made it to be something that it actually wasn't. And you see a lot of that in trading because the honest truth is, again, most of what we see on the charts is completely random. There are patterns that exist, but they aren't necessarily kind of profitable patterns. There are patterns within randomness, and then there are patterns at certain places in the market that actually mean stuff. And when we start giving power to randomness, whether it's a pattern or just like a strategy in its own right, we get ourselves into a lot of trouble. Moving average is something I see a lot of too, where, you know, it's very easy for kind of a YouTuber or a guru to create like a moving average cross strategy. And, you know, we talked about what curve fitting the other day in a podcast episode, show you a period of time where it works amazing, where it's like, man, look at this 3-month period, bang, 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 hitting them. But then when you go through an entire 2-year, 3-year, 4-year, 5-year sample size of data, it doesn't work at all, or it doesn't work through consolidation. Again, it is a pattern, technically, yes, but it's not necessarily a profitable pattern. And again, the reason we repeat this mistake is because our brain is lazy, right? And like I mentioned earlier, we have two choices. We can either take the hard route of kind of digging in and finding solutions, right? Recognizing what we're doing wrong and finding solutions to it. Or we can take the easy way and we can just make up an excuse. And we tend to just make up an excuse and go to the next easy thing because, again, the brain likes the easiest way to do things because it's less work and it is a machine. And machines like using less energy because it allows them to be more efficient and more productive. So after an extremely long ramble, what is the solution to this? Well, one, we have to remove the ego from the equation. Like I said at the very beginning, we're going to fall on one or two sides of the line, right? We're going to fall on the line of, I'm making mistakes, I need to do something about it, and put forth effort, time, energy in doing that something, or I'm going to take the easy way out and make mistakes. We have to accept that it is not, it is not the strategy's fault, it is not the YouTuber's fault, not the coach's fault, not the book's fault, not the broker's fault, not the bank's fault. It is our fault. It is completely up to us how we kind of mold and shape our destiny. And we have to accept the fact that, hey, as a new trader, I don't know as much as I think I know, right? This is that conscious and competent stage where you admit that, hey, there are things I don't know about the market. You have to admit that this is going to take time. This is going to take energy. There is going to be a learning curve to this. And you have to accept the fact that you may not be able to be successful with this super fun, run around everywhere type of trading strategy. You may have to adjust and adapt and do something that is more consistent, that is more boring, for lack of a better term, but also more profitable. So that's step number one. Step number two is turning that intuition into something that is usable, right? We want to kind of clear up that blurry space in between kind of the things that our brain is storing. So instead of just connecting the dots and being like, okay, well, I know where A is at, I know where Z is at, let me just put a line that goes from one to the other and kind of make up what's in the middle. We want to kind of fill in the gaps and put actual details in between that zone. And here's how we do so. Again, your intuition, your feel isn't necessarily wrong. It is created because of something that actually exists. The problem is everything that happens in between there. So what you want to do is you want to identify what this thing is that is giving you this feel, right? When you have this feel, this tingle that the market is likely to go higher, why is that? What did you notice? What did you see? What did you hear? You first want to identify what that is. Once you identify what that is, now you can track it. Now you can go test it. You can take that thing, whether it's a pattern, whether it's an announcement, whatever it may be. Now you can plug it through historical data and you can actually verify, right, if it's actually doing the thing that you think it's doing. Imagine, going back to the car example, really bad example coming up, but I want to make it. Imagine that before you bought the all black Range Rover, you somehow went on the internet and you actually got a number, you quantified how many people were actually driving all black Range Rovers. And then on the day that you bought it, you went back and double checked it and saw how many people were actually driving it to determine if people actually bought it when you bought it or if it already existed. That is a very bad analogy, but I made it. It's too late. It is in the podcast. But the point is, you want to test it. You want to take your double bottom, you want to go through historical data, and you want to see, does this double bottom actually result in the thing that I'm assuming it results in, or am I wrong? If you are wrong, then you either ditch it or play around with it, add filters and whatnot to kind of make it worth your while. If it does, well, now you have confirmed your feel and you've built your confidence. So it's a win-win situation. If something doesn't work, you can get rid of it and you're not going to recklessly lose money for an eternity. If something does work, well, now you have something that you can continue trading it, but now you can continue trading it with a lot more confidence, and that's going to allow you to be consistent during those dark periods where it doesn't work. So I hope all that made sense, and I hope you decided to actually listen to the podcast and learn from it instead of making an excuse and turning it off halfway because you didn't want to hear it, right? I guess if that's the case, you wouldn't have got to this point. But as I mentioned earlier, take the 10 episode challenge. Make sure you go back and listen to at least 10 episodes of the Trading Coach podcast. Just type in Trading Coach podcast and the topic of your choice and something cool will pop up. Or if you have a specific topic that you want me to talk about, just hit me up on the socials. I'll let you know what episode we discuss it in. Or if it's undiscussed or needs kind of a fresher discussion, I will do a podcast episode on it.